Well, John, thanks to American Federal Bank, we are producing another episode. What are we talking about today?
All kinds of stuff. Monday usually brings a lot of bad news. We had some good news. We got Trump tweets. We got interest rates. We'll definitely hit cattle at the end. We'll talk cattle in a possible cash top. I'm not saying it is. I'm just saying it's possible. And in one of the things I want to cover for sure is planning for December 26 corn, November 26 beans. We're definitely going to touch on it, why we're looking at that stuff this time of year, what can be done with even the storage issues. We'll go over some of that, calls, puts. We're going to cover it all.
Love it. Let's roll.
Welcome to Hedge Heads, where hosts John Prischman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we have a classic, let's call it a 2018 move in beans. A Trump tweet moved the market this morning. You want to talk about it?
Yeah, you wake up to what would be considered good news, sort of. At least the grains weren't down. We won't spend another whole episode about how they're down every single Monday, because this Monday it was up. 25, 26 cents, I think, at the most. It was the tweet that people that were up in the middle of the night maybe got to take advantage of. It mentioned China and China quadrupling their purchases of U.S. soybeans, or he hopes that they do. And it was going to be met in a timely fashion. And he thanked President Xi. So very cryptic tweet. But what does this mean? No one knows. The trade actually believed it, where you look on Twitter and so online and people mocked it, saying, quadruple times zero is still zero. You saw that one 100 times. That joke was old by
that's a good one. I like it. I didn't see the tweet, so I'm learning right now.
Yeah, for some reason it didn't fall in your tweet deck there, and it was all over this morning. Kind of disappeared. People mainly mocked it with the idea that there's nothing there, but really, when you break it down and think about it, why would he say that? Well, I can think of two reasons. That he's getting a lot of pushback for the trade war with China, or at least the tariffs, and the price of beans has been run down, and it's his way of kind of saying, I'm in your corner and I'm trying to do something. That seems really unlikely. It got in his head for some reason. It was very specific. It was about China and soybeans and nothing else. Something put that in his mind. So I hope we get to come back to this one, bring it up. I'm saying that it actually has meaning. I'm not sure what it is. Are they going to drop the tariffs solely on soybeans and start making these narrow alleyways where there'll be tariff-free to China, the grains? That would be a huge deal. But for some reason, it's in his head. He felt compelled this late last night or early in the morning to put it out there. That stuff doesn't just randomly pop in someone's head, anybody's head, and then just this spew nonsense without anything behind it. I'm going to be in the camp that there is something to this. What we don't know. What's your guess?
I don't have a guess. I have a question for you.
Yes.
So what do we do with this? Let's say, yes, something is happening. We're going to get more news. It appears to be positive news. What are we doing with it?
Okay, so if you look at just the fundamentals where we are for exports, the crush is going to be record gains for guys that crush beans in the U.S. The domestic should be good, where the exports are very poor. So now with this glimmer of hope, now if you make bean sales, which is very common at harvest, do you now cover it with calls saying, hey, this is a low price, beans are run way down? What I would consider the right call is March calls, because then you get to South American weather. You don't get totally all the way to harvest. But do I own calls now where if you're sitting there with 55 for a yield, something ridiculous carried over, and there's no news but the middle of a trade war, you're likely to not even contemplate buying calls. So now it's, do I re-own this if I'm going to sell it at a low price at harvest? That's number one for me, jumps out. And how do I re-own it? You got calls, you got call spreads, you have just outright long futures, which, you know, some guys do. Some guys don't have storage. And
Don't
they just
forget
buy
micro futures.
Yeah. But I mean, it's not uncommon for beans because there's not usually storage, especially on farms. So do you re-own it? On paper, they would call it. So do you just buy futures to replace those bushels? Do you write puts and say, I would buy futures if it got down here, otherwise I'll collect premium? It opens some doors in a market that just has everything not really going for it right now other than a spectacular yield. So at least the conversation's open. You need this in commodities. You can't just have bad news every single day. But I'm going on record. I think that there's actually something to the riddle of that tweet. It was just too specific and too peculiar to randomly do it without, what he likes to do. He likes to put stuff out there that he kind of knows the answer to. It might not be tomorrow that you see it, but most likely with the tariff deadline that got extended another 90 days to China, that there's probably progress going on something. And who knows what it is. But so I'm in the camp that maybe the trade was actually right. And then you go online and you got everybody, let's fade this thing. How do we fade this? I don't, nobody's calling let's buy beans. Most guys are saying this isn't going to last, at least online. Mm-hmm. The smartest of the smart guys online, they got it all figured out, so they got to let everybody know. But it was universally mocked, so I'll be in another camp. I'm going to be in the smaller percentage, and I'm not a perma bull by any stretch, but just the way it was worded tells me that maybe there's something there.
I am interested to see as well. I think there might be opportunities to look for pullbacks to find something, or maybe it's just going to run, or, maybe you do want to buy a put if you think you should fade it.
Yeah, and then you had last year, we ran up in beans for absolutely no reason all of September in a month that it's not known to go up for. We got to $10.90, maybe even $11. And some of the contracts got to $11.
November was $10.90. I just looked for someone.
Yeah, $10.90. So don't rule out a quick rally, and that brings me to corn. That's as crazy as it sounds. I'm contemplating buying calls in corn, and you can ask me why. There's a reason. Am I bullish? No.
I can tell you one reason.
What's your
volatility is way low. So
it is.
If you don't want to sell calls or puts, you might want to buy them.
Yeah. So I think there's going to be a rally in corn, 25, 30 cents. Just say, I don't know where the bottom is. I don't know what time frame I'm necessarily going to buy the calls in. It might be soon. It might be later. It depends on tomorrow's number. Some guys may be nibbled already. But the idea is that when it rallies 20, 30 cents, 25, that's not going to be enough to say, hey, I just put these in the bin, or I'm going to put this corn in the bin and I'm going to yank it out for 25, 30 cents. If you have a call in place before it gets to that price, then it's much easier to sell that than getting confused when it gets up 30 cents. What should I do? It's going to be approximately $4.50 somewhere in there for the March futures. And that's not quite good enough, but if you stored it in the spring, that's been a disaster too. So it gives you the courage to market it. And I'm not saying run out there and buy this. This is definitely different for everybody because of storage, what they're planning. You don't want to have a bunch in the bin and then just buy 100% calls on that. It's just a portion of a strategy that you'd like to keep upside open if we get a 25, 30 cent rally, because I think it's going to rally and I think it's going to confuse people. Like, what do I do now? Like, if you were in the middle harvest and you saw 30 cents rally, you're probably not stopping everything to haul everything in.
Right.
It's not going to happen. But you might incentivize you to do that if you have coverage. You got rid of it. You got your storage problems taken care of because you didn't have room for that corn, and now you can move it. So with that idea, that's where I'm at on that. It's not that I'm wildly bullish. It's just it would be nice to have coverage. Because of last year, what did we go to? $4.90, $5 for March? I think March hit $5, right?
Somewhere in that range.
Yeah,
I have not looked at that recently.
It might even hit $5.10. But then if you have your call on, you can take the profits in your call, throw it onto your sales, or you can just keep the call on, see what the South American weather is. Just a thought. Again, you don't hear me talk about that often, but they are so low priced, so close to the money. If you can figure out somewhere near the bottom to get these bought, odds are you're going to see some sort of profit somewhere along the way, or they could be really helpful marketing if you are having storage issues.
Right. There's definitely opportunity there, and that was going to be my question, was what do you do with corn and wheat? So do you want to touch on wheat since you hit corn?
Yeah.
Does this affect wheat at all, this tweet, this news?
Well, you never know. China did nibble on some Chicago wheat a couple of years ago when it got really low prices, so never say never there. I think they canceled a few of those cargoes too eventually, but they have bought wheat in the past. You have Japan obviously buys a lot of Minneapolis wheat and the higher protein wheats. So the Minneapolis wheat, I think, was rated 49% good to excellent. It was like 70, I think, last year. It was much higher last year. I don't remember. So is there anything there in wheat? No, not really. You have the world ending stocks, which they've been talking about for 2 years. You have, you think road everywhere. You can have an issue somewhere. It's going to be too hot. It's going to be too cold. No, overall, we need to see wheat continue to get exported. But we had a pretty big crop here this year, and that's going to be the issue, that the ending stocks are growing for Minneapolis wheat, growing for Kansas wheat, and they're growing for Chicago. That doesn't scream $8 wheat to me. Things do change quick in that market, but there's no signs of it in the spreads, no signs of it in the basis. They're going to haul in a big one here, although still the jury's out. I've heard on clients on the phone, guys that are pleased with the yield so far, they're harvesting, and then guys that aren't. You're hearing both. So it seems like the crop conditions are very varied for the wheat, where beans and corn are much better, and the crop conditions came out. We didn't climb in corn. I think we went down 1%. We climbed 1% in beans. So climbing this time of year is pretty bearish. How much does the market already have in it, though? Last year, we've talked about bearish stuff for a long time. Eventually, the markets get that in there. Now, the question is, where's the opportunities? And that, call us, and we'll go over exactly what we're thinking for the longer term outlooks. And we even December 26th, I've been talking to guys quite a bit about December 26th corn. It's never too early to think about next year. We're having conversations on that because it looks like it's too cheap, not too expensive. Like we got to lock this in and be scared. It's with the fertilizer prices and all the expenses. This looks like it's too cheap already. So if it gets pulled down further, that will probably create some opportunities for marketing for December 26th. That's exactly why you start following this stuff right now. To either it moves up and that'll provide an opportunity right now, or it moves down and provides an opportunity for marketing. And we'd be more than happy to go over specifically what we're looking at there. But it's also a good time to start following that. You're going to be worried about your new crop. That's going to be old crop here in just a second as you harvest it. Right. And then it's hard to think about 26, but you'd be surprised at when no one's looking what opportunities are there. And I won't kid you, there's really very few opportunities in anything. You're hitting singles and doubles right now. You can't commit to this price with these expenses, but that'll bring us to eventually the bankers will have a say in this. And one would think at this price or lower that the acreage is going to go down for corn and the whole cycle begins again. So it's never too early. I have not been following 27 except for the December 26-27 spread. And I think it's way too early for 27.
Yeah, I think you made an important point that I want to stress, in that it's easy to get distracted by what you're harvesting now and the price of that, when your focus should be looking at all opportunities across the board. So pay attention. It's not make a move necessarily right now, but pay attention.
Yep. The better marketers usually are marketed out 2 or 3 years at higher prices. Of course, that's not what we're going through right now. But you might have had guys shorting December 26th. Let's say we did rally the summer at 530, and they're already marketed. That's very common for guys that get those prices when you're in the cafe and you listen to, I'm hauling in 550 corn from a couple of years ago. That the price was up there. Those are the guys that tend to do better. That kind of, when everybody's buying it and they say it's going to go up forever, they're marketing out at 1 or 2 years. Even if you do that, there's still the call. Like, let's say let's say you do market 530 corn and it comes off and it's actually way bigger, and this is in July, it comes off and this crop was way bigger than they thought, and all of a sudden we're where we are right now, 450. You can turn around and buy your courage calls at 530, which are probably like 8 cents, maybe 10 cents, and then you have coverage for next year's summer weather. So again, it's not all about it has to go up and then I do something. It goes down and then I'm doing something, and that's exactly what market we have right now. Is that it's going down? Is there anything that I should do or start planning for next year? There's nothing that you're missing. Like if you don't do it, your marketing is going to get ruined. These are bear markets. But there is things that you can do to help yourself to make marketing easier. And we can run a bunch of ideas by you. I just wouldn't give up. The guys that just give it up, throw it in the bin and say, I hope I get a better price. They tend to struggle in bear markets. Even if you do a little bit of incremental marketing, a little bit at a time to try to average your price out, it's still below the cost of production. If you wait for the big home run, $5, then I'm going to sell everything, that might not come. You might be holding $4 corn into next summer. So it is, believe it or not, still time to plan. Even if there's nothing to do today, Trump could tweet tomorrow again, and all of a sudden there is. Like I say, there was nothing in beans that I felt compelled to do. Now it feels like, if we get a further dip, maybe that we're going to do something. They probably will fade this rally unless there's more news. But it's always about planning, and more planning. Unfortunately, these markets aren't very good. Like, we're not selling a bunch of premium. We're not selling puts. We're not selling calls. Some guys want to sell both sides. There's just so little premium. So I'm more on the buy side of stuff than the sell side right now. But that doesn't provide tremendous opportunity either. So we're kind of stuck in just plan and have an open mind and have your goals. Like what would a price target even be for a whole crop? Start getting these ideas in your head so when it happens, you can mark it. Again, I'm going to probably be looking at calls at some point, and with the idea that it's going to make it much easier to market later on a market that's been run down. Now, the problem is they can run it down a lot more, and we have that report tomorrow. What's your number? Y'all want to hear Ryan's number for tomorrow's report on that corn?
I have not been paying attention enough to even give you a guess.
The average analyst is at 184.2, and I think it's coming under that just because why do they need to move it up super fast?
Right.
And it's likely to have a more positive than negative reaction if that were to occur. I would even think 183 probably gets there. That it doesn't matter much in August, but you string August, September, and October reports together, and if you see like us, let's just say we go to 183, then September goes to 184, and then you see in October 183.5. That's very constructive. Where if you see it like get bigger every single report, then they're going to fear the January report. It's going to really have a tough time rallying if they think that January report's going to be a bad one. Last year was really good. They cut it, 3 bushels? So we're going to have the first glimpse at this monster crop they say is out there and what the USDA is going to say. I think we're going to land right at like 82.7, somewhere in there, 182.7. Beans, they probably will move up a little bit. The market fully expects it. So that's the good news about it.
Right. I have been seeing a lot of ugly corn pictures on Twitter. So,
Yeah, it is the season. They'll pull back, and there'll be a number of problems that they'll say that it isn't what it looks like from the road. Of course, it's very personal, and there's going to be bad fields out there. But then you hear other guys that have driven around multi-states. Some of these guys I'm talking to on the phone, and yeah, there's optimism that this is exactly what it looks like it is. It looks awfully big here. It looks like Field of Dreams here. I mean, it looks just like the movie, like Hollywood would put up for corn. So it looks awfully good. The markets, about this time of year, usually digest this news. Unless we see something crazy like a 187 number tomorrow, and I don't know why we would. I think there's one guy at 188. There's always a high guy.
Absolutely. You can't have an average if you don't have an outlier.
Yeah, so if you see the way above 184, you'll go down tomorrow. Otherwise, probably very little opportunity, maybe a bounce if it's a little lower than I think, but it's going to be big. It's going to be big, a big crop, big number, and a guy's going to have to deal with that.
Absolutely. Well, let's get into interest rates and currency a little today, brought to us by our friends at American Federal Bank. What are you seeing on the interest rate side? It's been, to start August, the 10-year was up, meaning interest rates down, correct?
Yep.
Quite a bit, but since then it hasn't really been doing anything. What are you watching there? What's news? When should you be looking at refinancing things?
Okay, so then that'll be an important question going forward here, especially with operating notes and all that stuff. It looks like you have lower rates coming. Of course, there's the tiff at the Fed and Trump and all that stuff, but the economic numbers don't look great. It doesn't feel like inflation's running really hot. Now, inflation's still there. It's very sticky, like that's what they call it, sticky inflation. Cost to build a house or anything, all the costs are still rising, especially insurance, medical insurance, car insurance. So people are feeling the squeeze, but that in turn will have people spending less. So it's likely that in the final stage of inflation here, that it goes to a high enough price where people buy less. We really haven't seen that yet, especially with beef and cattle. We haven't seen that demand destruction on much anything, but the numbers are starting to come in, and it's going to lean more towards lower rates than higher rates. The rest of the world is lowering, so we're keeping it steady. We had that meeting, and it had a positive reaction, meaning everything went up and rates went down after the meeting. And then since then, rates have crept up just a little bit in the short-term stuff. But overall, it would look like it's coming down. But unfortunately, it's got a little political. So, there's guys that think they're going to cut 4 times by the end of the year or, into early next year. I think that you could get a rate cut, but again, it's gotten so political that it might be hard. He's not going to want to look like he's listening and being told what to do, or the Fed isn't going to like that. So, but lower is more likely than upper right now, unless you were to see inflation numbers really start cruising again. And again, I understand everything's up, but nothing's really come down. And there is inflation, but that in turn will ruin the demand on a lot of side stuff. Look at UPS stock, although you can't just judge it on their stock alone. But people are buying less without a doubt. And the groceries, I don't know if anybody's been in a grocery store lately, it's a little bit expensive. I mean, it's actually really noticeable even from a year and a half ago. Like, or even last year, like everything just seems to go up every time you go in the grocery store, doesn't it?
It really does.
Yeah, it's weird. Like, it's just this sneaky, another 20 to 30 cents on everything from soy sauce to shrimp. It doesn't really even matter. Pork is the only thing.
It's either that or smaller packages.
Yeah, shrinkflation.
Yeah, the shrinkflation is real.
Oh,
holy cow! Buy a bag of chips sometime.
Yeah, or
$4 and you get 2 handfuls.
And I got the little Snickers snack bars. And I don't think I've had one of those since I was a kid at Halloween. And it's not even the same candy bar. I mean, what is that thing? They have like a little 5 in this one little pack.
Yeah.
And there's barely anything there. It's not even the size. There's just like the contents. There's nothing else. There used to be like caramel and peanuts in there, right, and like nougat. And now it just seems like a thick layer of nougat and a little bit of chocolate. And the chocolate layer is thin too. So it was really surprising to me because I just don't have that stuff too often. But shrinkflation is real. So more likely to go down than up. After the last podcast, I had a few guys calling the interest rate stuff. So what you want to do is start following it, get a feel for it, and then ultimately trade it if you want to. But it's not something you just dive into. And it's not something that's necessarily easy. You can't just say, hey, I think that they're going to lower rates, so let's bet the farm. It's just, you got to watch the economic indicators, kind of the general feel of where the economy's going, and then it tends to trend that way for a while. It's been very volatile because, different president, different policies, a lot of different stuff with tariffs. But now we're starting to smooth out, and it's likely to trend in the direction soon that it's going to go. And I think lower.
Yeah.
Rates lower.
I tend to agree with you. What do you think on the dollar? I mean, we're sitting the lowest we've been in 3 years. Lowest we've been since 22.98 cents here.
And look at
what do you think? I know that will affect exports for sure.
Yeah.
But where do you think it's going? And what's the goal, do you think, from
Well, look how well corn sold last year. Really, all the grains, they had a decent year, especially corn, and it was 107 this time last year without even looking. I'm sure it was up near there. So that helps out a ton on the export side of stuff, and we're already seeing that in beans. Well, not beans, I mean corn, a little bit in wheat some weeks, old crop beans, you could say, but it'll be very, very helpful for our exports, and it's, I believe, by design. They're more likely to pursue a weaker dollar policy than a stronger dollar policy. If we remained way high on interest rates, that's going to attract a lot of foreign dollars that they have to turn into U.S. dollars for our interest rate. So you got to watch interest rates, but if our interest rates go lower, I would definitely think the dollar is headed lower as well. Going to help exports. It certainly is better than last year.
Makes sense.
Yeah, wheat's probably the most sensitive out of anything. Corn is a close second. But we've lost our wheat export market many years ago, and it really hasn't come back.
Maybe this is the year.
And maybe there's going to be a wheat tweet here pretty soon.
You never know.
You never do know. But still, at least something interesting happened today with that tweet. Everyone's going to kind of laugh it off, but I still think he thinks about a lot of different stuff. And why would that pop in his head? Obviously, there's been some conversations. I don't think it was a random thought. People kind of underestimate him sometimes on the trade stuff. So it'd be nice to see something there, but at least there's something to talk about that's positive. We're up 23 today.
Absolutely.
Unrecognizable. Even corn was up a few. Of course, it can't hang on to that.
Weird for a Monday. Well, let's talk energies here. Lately, let's call it the last 5 months, oil will creep up, and then definitely take the elevator down.
Yeah.
What's going on? We just found where we want to be, or it's international politics. So when the price gets up there, they make an announcement to drive it down. What's going on in the energy market?
You definitely want to watch the Russia Trump Putin meeting for sure. That one is going to be a big one. If it goes well and things start looking like they're going to get hammered out, sanctions could be dropped on Russian oil. There'd be more oil available, legally for everybody, even though Russia's still selling plenty to everybody, India and in China, it'll be in the open. It'll be not sanctioned possibly. So that would be negative prices. We already have what we just talked about with interest rates, kind of a negative feel to the economy, a slowing down. I think that's why you see all rallies sold in oil, that it's just not that, it's not like a sustained move on good fundamentals. Like the fundamentals are, I'd say, poor. That's why we're at $60. The outlook is so, and we're kind of stuck in this range. But every rally is shot down fairly quick, and it's really unusual to have oil and the energy's this quiet. Like you're just not getting calls on diesel or unleaded gas. Like it's just settled into this range like cattle did 4 years ago. Cattle went sideways for about 2 or 3 years, and there was hardly any cattle calls. Guys weren't buying puts. They certainly weren't doing LRP. They weren't doing anything. It found that price where what oil's doing, where it's comfortable, still being produced, yet the upside's capped by a lot of different reasons, including there's plenty of oil around right now.
Absolutely. Speaking of cattle, what do you know on the meats? Any hog or cattle news you want to?
Yeah, huge down day on Friday. Down $9.25, the limit. They moved the limit to $13 in feeders today. It didn't need any of that. Saw both sides, which is what you're going to see in a confused market. Now, this is the second Friday in a row this has happened. Maybe it was July 31st was that end of the month.
Yep.
But it's probably, So,
Yep.
So this one is another warning shot to a tired, no pun intended, bull. It's been up here for a while. What's likely being anticipated is the demand side of cattle falling off. It's the time of year when that happens. Kids go back to college. My son had soccer practice already for high school this morning. They're doing 2 days, which I'm sure he loves. But what that marks is the end of the grilling season. Everybody starts getting busy. Not that you can't grill, but that summer grilling, the big parties, you might have one more for Labor Day. That starts to wind down. You guys get busy and distracted. And the steak price is already so high. you would think that you're going to see your normal demand patterns this time of year. And if you look at the seasonal charts, mid-August into the beginning of October is a very, very bad time to be long cattle. And I'm talking in a regular year. I think a little of that's going to show up this year. I think it's got the trade worried that we might have topped out on cash there. We don't know. I mean, we've seen this play out. What happened is the South traded at 237 early in the week, and then by Friday it traded at 235. That's a different pattern. Started off stronger, went back to unchanged. Cash cattle is everything this week. If we see a lower print, I think that you're going to see another big sell-off. Box beef is being supported by the lower slaughter. So there is low supplies out there. It's just this balancing act. But I think we're on really, really thin ice right now.
Do you think if you had to guess, pull out your crystal ball, this is not trading advice, just John's personal guess. Do we go down or do we just start trading this range for the next couple months?
Okay, so that's a hotly debated point. With the supply, you would think it would come off slow and like there's not enough around, but that's not the way speculation works. So cattle market is loaded with long speculators. You have short on the commercial side and then long. There's one for one. But the commercials are hedge short, so they're not getting out until they sell their cattle or the hedger. And then the longs can get out anytime, and they might be headed on a family vacation to the Bahamas, and we're going to cash in, our tens of millions of dollars we made long cattle. So they don't have the same allegiances as like a short hedger would. He's not getting out unless he has to. The longs can get out, and if they do, and they start tripping each other's trigger, and the squiggly lines start crossing other squiggly lines, you could see, and we've seen this in the past, where it really overdoes it. Meaning it could get to a price that you can't believe, at least in the short term. I mean, we saw 189 not that long ago.
Yeah, just back in May, I think.
Yeah. So when they get out, it could be an elevator shaft down. Now, that being said, this is why I like puts way better than LPR. Because if it does do that, let's say you have March feeders and you have a March put, which a couple guys have bought, or January puts, it comes off $50, just for argument's sake, on liquidation. Nothing to do with cattle, and all of a sudden we're way under the cash index, like way under, and the live cattle are way under. You can have negative 20 basis. We saw that last year at this time.
Yep.
You can have negative 30 basis. It can get out of whack for a period of time. With a put, you can choose, hey, I don't think I need protection anymore. I can get out. LRP, you're just locked into your window. So much more flexible with a put than LRP. And that's what you could get. You could get a big giant dive, and it could way overdo it, and then it would find its equilibrium eventually. Like, in other words, you couldn't have futures drive cash down to nothing when there's not a lot of cattle around, but you could get way under cash for a while. So look for futures that have a lot of volatility back and forth as confusion sets in up here. That's generally how tops are formed, with some volatility at the top. I would expect that to happen. People are looking for a technical sign, looking for a fundamental sign. There's been nothing so far besides 2 Fridays in a row now have been pretty bad. And then Monday acted just like the last Monday, where it didn't do much, ended up a little bit. Then tomorrow's a big day, in my opinion. That's the day whether cattle is going to say, hey, this is another dip to buy, cash is going higher, or there's going to be some warnings that this might be over for a little bit, at least a temporary top. So I think tomorrow, Tuesday, by the time you hear this, it might be Tuesday, is a very important day for cattle and the direction I think we're headed for the next couple weeks.
Excellent. Well, John, we should wrap up there. Why don't you leave your number if anyone has any questions?
Sure, 218-731-1578.
Thanks for joining us.
Sure. But it's very cryptic, very friendly. He just extended the tariff deadline another 90 days. Like they're working on a deal of some sort. Sure looks like it.